So if we do our differential analysis, we take the purchase price of the instrument panel. What we're paying for it is $240 right now. If we look at the cost to manufacture, direct materials, direct labor, and we're only looking at the variable overhead because the fixed overhead happens no matter what. Whether we make or buy this instrument panel, the fixed overhead's already going to be incurred, so it's irrelevant to this decision. We're only looking at incremental costs to manufacture it. So it would cost $212 to manufacture it. We're paying $240 to buy it. So we're seeing a $28 cost savings by manufacturing it ourselves versus buying it. So here's an example of that a manufacturer we're considering replacing old machines with new ones. So the book value of the old machines is $100,000. There's a 5-year remaining useful life. The new machine costs $250,000 with a 5-year useful life. We could sell the old equipment for $25,000, but we know that the new machine will reduce annual variable cost from $225,000 to $150,000. So a $75,000 cost reduction. Should we buy the new machine? So let's run our differential analysis. So our annual variable cost for the current machine is $225,000. Current variable cost for the new machine would be $150,000. So our cost decrease would be $75,000 a year. We know that there's 5 years of a useful life, so our total decrease in cost over 5 years would be $375,000. And then we could sell our current machine for $25,000. So if we add up our costs that we could save over 5 years, the $375,000 plus the $25,000 we can get from selling the current machine, that gets us to $400,000. The cost of the new machine would be $250,000. So our net differential decrease in cost over 5 years is $150,000. The $400,000 up we go for cost savings in the sale, less the $250,000 we have to spend on the new machine. So our 5-year savings is $150,000. If we divide that by 5, we see a savings of $30,000 a year by buying the new machine. And we focus only on the relevant cost. The book value of the equipment that we currently have is sunk cost. It's irrelevant. We already spent it. So we're only looking at the relevant cost of the decision to replace the equipment. So opportunity cost is the revenue that is foregone from an alternative use of an asset. So we can assume that the $250,000 for the new equipment less the $25,000 sale could be invested to yield a 15% return. So we could take that $250,000 and buy a new machine, or we could take that $250,000 and invest it in the market and earn a 15% return. So the opportunity cost of spending $250,000 on the new machine is the 15% return we can get in the market. So the annual opportunity cost for that new equipment, the $225,000, which is the $250,000 less the $25,000 sale of the old machine, times 15% return. So our annual opportunity cost of the new equipment is $33,750. So that means that the opportunity cost is what we could get in the market instead of buying a new machine, so buying stocks or bonds. So looking at opportunity cost, it's not beneficial to replace the equipment, because when we replace the equipment, we see an annual cost savings of $30,000. But we can save more money by taking that $225,000 we were going to buy the equipment with, putting it in the stock market, earning 15%, and we can earn $33,750. So from a company perspective, we're better off keeping the old equipment and investing that money at a 15% return. So let's look at the process something or sell it as it is. So a 4,000 gallon batch of kerosene sells at 80 cents per gallon. produced from 4,000 gallons of raw material at 60 cents a gallon. We could continue processing into gasoline, which costs us $1.25 a gallon, which would be another $650 a batch. But we're going to lose 20% of the gallons of kerosene during this extra production. So do we keep processing it or do we sell it as kerosene? So let's look at our differential analysis. So our revenue from the sale of gasoline. So we're going to have 4,000 gallons less 800 gallons, because remember 20% of it evaporates, times $3.50. So selling it as gasoline, we get 11,200. If we sell it as kerosene, we get the full 4,000 gallons, and we could sell it at $2.50. So our incremental revenue from selling it as gasoline is $1,200. And then it's going to cost us an extra $650 to make it gasoline instead of kerosene. So our net income increase is $550. So based on this, it would be better to process it as keep going and process gasoline instead of selling the kerosene. So let's look at accepting business at a special price. So a company, we currently produce 10,000 basketballs a month. We have a capacity to produce 12,500 basketballs. We have our variable costs, fixed costs, and our selling price. So we got an additional offer of 5,000 additional basketballs, $18 each from a foreign buyer, and we can produce them over 3 months. Should we accept this offer? So our additional revenue for those 5,000 basketballs, so 5,000 basketballs times 18 bucks, 90,000 in revenue. Our additional cost is $12.50 a basketball times 5,000 gets us 62,500. So our additional income, our differential income from accepting the special business is 27,500. So remember that point about how many basketballs we can produce versus how many we do. We can produce 12,500 a month. We're only doing 10,000 a month. So we have the additional capacity to produce this 5,000 order. So we don't have to incur any additional fixed costs. So in this case, we should accept the offer.